you. So hello, good evening, everyone, traders, wherever you are watching this presentation from FX Pesa. Hello, Ambrose. My apologies for the delay. We had network issues. So today we'll be looking at a topic that maybe some of you are familiar with, fundamental analysis. This is where we are looking at the economic, political, social effects on the financial markets, right? So without so much ado, let me get into it. So as a trader, one thing that we found majority of the traders don't take into consideration is fundamental analysis. And fundamental analysis is very important because at the end of the day, if you're really a good technical analyst and you miss out on the fundamental aspect, you could suffer losses in your positions, right? Because news tend to bring in volatility into the market. Remember, when you have news, buyers and sellers will always be seeking to look at the direction of the market and maybe take a position on that particular asset. Let's say if you're looking at gold, maybe when you're looking at a certain decision that has been made with regard to maybe the politics of a country, you know, so everyone is looking at that country and saying, you know what, there's so much that this country does in the world, and whatever happens in that particular country will affect the world. So you'll find gold traders coming in with a view of trying to set the trend. If the politics are stable, then of course there will not be much investors getting into gold. But then again, if there's political havoc, then what happens is that traders tend to go into gold because gold is considered a safe haven. So let's look at an introduction to fundamental analysis. What are we talking about basically when we say fundamental analysis? So the role of fundamental analysis is basically currency valuation. At its core, forex trading involves buying one currency while simultaneously selling another. Fundamental analysis helps traders determine whether a currency should strengthen, appreciate, or weaken, depreciate against another currency. So look at it this way. When you look at, we'll have a look at that, the fundamental aspect where you're looking at the economic news, where you're looking at all these calendar outputs, especially when we look at maybe data that's coming out, the Fed and the ECB, the European Central Bank. So as a trader, you must always seek to know what's going to happen in the market, right? Because once again, like I said, when this news is coming out, there are traders who are waiting to project where a particular asset will be moving based on the kind of news that will come out. If it's positive, then maybe you'll see the dollar strengthen. If it's negative, you'll see the dollar weaken. So which goes back to point number 2, long-term and short-term movements. Depending on the nature of the news or event, fundamental factors can drive both long-term trends and short-term market fluctuations. If you guys will remember sometime last week, or even let's say the beginning of this month, NFP, what happened is that there was the market strengthened and then it weakened, right? So you had two short-term market fluctuations where like the market went on an uptrend, and then all of a sudden the market went into a long-term short trend. So, and that's why if you look at currencies, you'll see that particular movement, especially currencies that had the quote currency as the USD. They went up and then later they dropped. So it's always important to understand that fundamental analysis is a key element when it comes to trading. So what do we look at? in fundamental analysis. Interest rates, typically currencies from countries with higher interest rates often have a higher demand because they offer better returns on investments denominated in that currency. Central bank meetings and announcements are crucial events that traders watch. Now, we all know the Fed, the Federal Reserve, the central bank of the US. We know the president, the chairman, Jerome Powell. So this is basically when we have inflation, when the inflation is high, what the central bank tries to do is that they try to intervene into the market. And how do they do that? They increase the interest rate. So anytime there's inflation news coming out and there has been an increase in inflation, there's that expectation by traders that interest rates will also be pushed up to rein in on the inflation. Remember, what is inflation? The steady increase in prices of goods and services. So if prices of goods and services are increasing let's say every other month, it becomes sustainable for majority of the folks in that country. And in most cases, for example, in the case of the US, the main reason as to why you have so much inflation was because of the COVID period, where the US government through the Fed printed dollars in a process called QE, quantitative easing, yeah, and that led to a lot of money in the US economy because the US government had to make sure that since guys they're under lockdown, they had to eat, so that's where like the money had to be printed. And it was this money that was being spent was being given out to the banks, and that's how the ordinary Monanchi used to get money to cater for the expenses. So when the COVID came to an end, what happened is that now the central banks decided, you know what, everyone has gone back to their hustles. The government is able to collect taxes, and all of a sudden there was so much money in the economy, and prices of goods and services, of course, went up because of the forces of supply and demand. All of a sudden, you have these guys with lots of money, and they are in demand of, let's say, a certain product. So of course, if everyone is requesting for a certain product, what will happen is that the price of that product will definitely shoot up. So to rein in on this, inflation has been increasing, and the government had to step in and mop out the excess money. And how do you mop out excess money? Is by increasing the interest rates. So when that happens, what happens is that majority of the guys, when the interest rates are high, the continuous increase in interest rates lead to an increase in the yields of bonds. So you see investors, let's say the Chinese government, the Saudi Arabia government, they tend to buy the treasury bills and bonds in the US. So once again, how does that play out with regard to the increase in the let's say the dollar? Supply and demand. All of a sudden there's a huge demand for the dollar as these investors get into the US. Remember, we've said forex trading is the simultaneous buying and selling of currency. So someone from let's say Japan, and they want to invest in the US, they definitely have the yen. So if they want to get into the US and buy the treasury bills, they'll have to exchange the yen into the dollar. So what will they do? They will sell the yen and buy the dollar. So that buying of the dollar is where there'll be an increase in demand for the dollar. So once again, an increase in demand for a certain product leads to an increase in price of that particular product. So in this case, the dollar strengthens. So interest rates is something that anytime you look at the market, you should make sure that you know that when there's an expected hike in the interest rates, the particular currency will be affected. If it's the dollar, if the Fed will be hiking the interest rate, the USD will strengthen. If it's the ECB, they're looking through Christina, they're looking forward to increasing the interest rates. What will happen is that the euro will strengthen also. So we also have economic indicators. Here we're looking at the GDP, the gross domestic product, and then we're also looking at the employment numbers and of course inflation. So basically, if there's a strong GDP, gross domestic product, it means that that country is doing so well. Like there's so much output coming from that country. It means almost every other facet of the economy is playing out well. So that means as an investor, you interpret to say that the country is strong. So any investor would want to invest in a country which is doing well, right? So There's also political stability and performance. Countries that are politically stable tend to have stronger currencies because they are considered safer investments. On the other hand, political upheavals or uncertainty can weaken a country's currency. So this goes without saying. If our politics are not stable, then of course most investors tend to run away from that country, because I mean, you're an investor, you're looking at returns for your money. If that country you're investing in is not stable, then no one wants to invest in such a country. Now go back to the analogy of demand and supply. So all of a sudden there's less demand for that. If let's say it's a country like the US, if the politics is unstable, all of a sudden there'll be less demand for the dollar because no one wants to invest in that country. So what happens? The dollar tends to weaken. So we will look at the safe haven pairs, especially when you're looking at gold. This is where gold comes in. Like if there's instability, let's say in the US, what investors tend to do is run into gold. They really want to invest in gold, which is something that most traders seek whenever there's this instability, wars, or even earthquakes, some of these turmoils that happen in the world. Speculation: if traders believe that a currency will strengthen in the future, they will buy more of it now. So basically, this is where you look at sentiments of traders. If majority of the traders are saying in the next, let's say 3 months, oil will still be increasing due to the action of, let's say, what Saudi Arabia and Russia have been doing, cutting down on supply. So if traders still believe that Saudi Arabia and Russia will continue with the same stance, then what will happen is the prices of oil will continuously go up. Natural disasters or terrorist attacks, these are events where some of them are just unforeseen, and this is where through our FX Space academies and even through these online webinars, we normally emphasize on the need of you guys to make sure that you're observing risk management. Why? Because you could be the best trader in the world, but a small impact, let's say some earthquake effects, God forbid, let's say like Wall Street, New York, that will be catastrophic, and this is where investors and traders will interpret that data to mean, what, wow, we don't know how far this country will recover from whatever has happened. So what we do, let's make sure that we're investing in these safe haven pairs. The Japanese yen is also at times considered a safe haven pair. So this is where now the risk management, use of a stop loss, position sizing, using the right leverage. You must have that in your positions to ensure that you're protecting yourself and also your trades. So employment important reports here. We are looking at the non-farm payroll, the initial and continuing jobless claims in the US. Remember, if, for example, in this initial and continuing jobless claims in the US, if so many guys are claiming that they are unemployed, and the numbers keep increasing, it means the US economy is not doing well. So what does that mean? It means investors will tend to lose confidence in the US economy, because once again, goes back to that point where no investor would want to put their money into a country that is not performing well, because you invest your money with the hope of a certain return, and that return only comes in when maybe an economy is doing pretty well. So all these will have an impact on the dollar. We'll have a look at that in the economic calendar. And we also have central bank minutes. Here we are looking at the Fed decision rates, the ECB. Whatever decision they make will have an impact on those particular currencies. The consumer price index, it measures basically inflation. So here you're looking at the prices of consumer goods and all these kind of goods. And basically when the consumer price index is high, it means the inflation has been increasing. So that means the central bank will use some of this data to make a decision on whether they'll keep hiking the interest rates. GDP, I talked about this. Basically, it provides a broad overview of the country's economic health. So if you want to know how healthy a country is, you'll want to look at GDP. Okay, there's the whole conversation that GNP is more fruitful than GDP. But then again, the gross domestic product is something that you look at. If you have positive GDP, it means the country is doing well. And so the exports and the imports are more that kind of thing. And then also the balance of trade indicates the difference between a country's exports and imports. Remember, no country is an island by itself. So every country is doing some import and export. So when a country has more exports than imports, it means it's doing pretty well and there's a demand for their currency, right? So more currencies are coming into their country. And then if you're doing more of imports, it means you'll have a deficit BOP, balance of payment. So it's always important that you look at some of this data. And how do you look at this data? You go to the economic calendar. We have two types of main types of economic calendars. We have MyFXBook. We have Forex Factory. We also have investing.com. In my case, let me go to my FXbook so that we look at the data that will be coming out tomorrow. So I normally say every trader, when you wake up, make sure that at least you have this data coming in every day. When you wake up the first thing in the morning, just look at the economic calendar. Get to know what will be happening that day, because if you don't do that, there's a high chance that you will suffer losses if the news come out against your positions. So this is my FX book. So if you look at this week today on a Monday, you guys will understand why the market today was slow. Of course, on Monday, you'll always have this slow market. Why? Because majority of the traders, the New York traders, will be coming in late in the afternoon, Kenyan time, and so there won't be so much volatility. Remember, we always say when you have 2 or more sessions open at the same time, that's when you'll expect a lot of volatility. Because if you look at, let's say, the Frankfurt session, the London session, and the New York session, when those markets are open, there's always so much volatility in the market. So let's look at tomorrow. Today, we have RBA meeting minutes. So remember, at 4:30, if you're trading the Australian dollar, and of course this will also affect New Zealand the NZD. So make sure that if you have a position, if you're in profit, move your stop loss in profit, maybe to protect your position, because the RBA meeting minutes, this is the Reserve Bank of Australia. It will have some impact. Definitely there'll be some volatility in the market based on that news. And then we have also the inflation rate. Look at this. This is something that you also need to look at if you're trading the Canadian dollar. So make sure that you take note of this. We will see consensus. Majority of the traders are saying it will be 3.8%. If the number comes out, let's say 3.9%, then expect the Canadian dollar to increase in price. If it comes out 3.7, then you'll expect a drop in CAD. So just look at whichever currency that has CAD and have that in mind. We also have the building permits. If there's an increase in the number of building permits, it means the construction industry in the US is growing. So that means the US economy is healthy. There's so much demand for houses. That means there can't be a demand for houses if people don't have money in their pockets, right? So that means the economy is doing well to a point where guys are building houses. That's basically what that means. So if the numbers come out more than what we have here, higher than that, then it's positive for the dollar. That is on Tuesday. On Wednesday, we have the balance of trade, what we've looked at, the Japanese. So there's this number, 659.1 billion yens. So if the number comes out more than this, then it means it's a plus for the yen pair, right? So when it's a plus, it means the Japanese yen will increase. So anything against the Japanese yen will drop. So if let's say it's USD JPY and the number comes out positive, we expect the USD JPY to drop. If this number comes out lower than what we have, it means that whole imbalance where like maybe it's like you have more imports than exports, right? Basically, but the yen will definitely have drop in price. We'll see the yen dropping because of that particular news. Look at GBP once again. This will be on Wednesday. We have the inflation rate in the UK. So the consensus is that the number will be 7%. We know UK has been struggling with inflation. So if the number comes out 7.1 and above, then you expect the GBP to increase in price. It will strengthen. But then if the number comes out, let's say 6.9, then we will see a weakening GBP. Now, the most important news of the week, we have the FOMC economic projections, and also we have the Fed interest rate decision. So what we are looking at here is 5.5, 5.5. So majority of the traders are saying that the Fed will not hike the interest rate. So what happens when the Fed hikes the interest rate? So we should see a strengthening dollar. And then maybe if the price remains at 5.5, the market will have priced in this particular number. So we probably won't see so much volatility. But then again, as a trader, this is where like you must make sure that you're combining risk management in your trades to protect your positions, right? And then Federal Open Market Committee, this also, they'll give out their projections. We'll have some volatility. And we see at times you'll see a spike in the market based on these news, and then FOMC economic projections, another spike. So you could see an upward spike and then a downward spike. So these are things that will bring in volatility into the market. And then of course we have the USD press conference at 9:30. Now here traders will be keen to hear whatever the projection that will be made during the press conference. Maybe you'll hear them saying we expect to have an interest rate hike maybe in December based on the numbers, or maybe they're still waiting for more inflation data to come out to determine. So this is the conversation that traders wait for. And of course, maybe we'll see some volatility on Wednesday at 9:30. So on Thursday, we have another one, the Bank of England interest rate decision. So we can see the consensus is that there'll be an increase from 5.25 to 5.5%. What happens if BOE increases that with more than to maybe 5.75? Yeah. With 0.5 basis points. So these are possibilities that you should never lock out, right? So you should always be careful when you're trading these positions. Remember that news will be at 2 p.m. Kenyan time. So we've already discussed about the initial jobless claim and the continuing jobless claims. So this is also information that you really need to take note of. So for example, in this case, we have 1695. This is what the consensus, what traders are saying, this will be the number. If it comes out higher than 1695, let's say we have 1700, then that means there is more guys where there's more people who are jobless, there'll be more claims, right? So that will weaken the US dollar. That's for a fact, the dollar will weaken. If you look at the initial jobless claims for September also, the expectation is that there'll be 225,000 to 25K. So if we have a higher number than this, of course, it means traders had expected 225K, then it comes out maybe to 30K. Then that means more people are jobless in the US than expected. So that means the US economy is doing far much worse than what traders expected. So of course, the dollar will weaken. So these are some of the things that you need to look out. Existing home sales, this goes without saying. If the number of home sales, if they increase, then it means the economy is doing well. So it means that more guys have more money to buy houses, right? That's basically what this data means. So anytime you're looking at this data, interpret it in terms of money, in terms of how much money is circulating in that particular economy. So if there's a decrease in this number, it means majority of you see, when you're giving this projection, it's based on the outlook of the overall health of that economy. So if the numbers come out less than 4.1, it means clearly the US economy is not doing well. So that will lead to a weakening dollar. So if the numbers come out stronger than this, of course, we should have a strong dollar. On Friday, we have some interesting data. We're also looking at the inflation rate in Japan from 3.3, maybe whatever number. Remember, the goal of every central bank is to have inflation at 2% and lower. So 2% is the ideal percentage. So if this number comes out higher than 3.3, you should expect the Japanese yen to strengthen. Why? Because of that possible. The repercussion of an increase in the inflation rate is that the Bank of Japan would step in to hike the interest rates. Yeah, so retail sales, the same thing. Basically, here we're looking at this data will come out at 9. So just be sensitive, especially on Friday as we close the week, that you're able to understand that an increase in this number from 0.5% to, let's say, 0.6% means that there's more money in the economy. So traders will translate this to mean that the economy is doing pretty well. And so the Great Britain pound will strengthen in all these facets over here. So when you're basically looking at the euro, you might want to look at maybe what's also happening in in Germany. So that you're able to because Germany is the biggest economy in the European Union, right? So whatever data comes out of that economy tends to influence the other economies in that context. The same retail sales, Canadian dollar over here, we expect some volatility. So if the numbers come out higher than 0.5% in all these facets over here, this one gets to 0.6%, we should expect the Canadian dollar to strengthen. If this gets to 0.5%, the Canadian dollar will strengthen. And the reverse is true. If it gets to 0.4, the Canadian dollar will weaken. So make sure that you take note of this. Basically, this is more of a introduction to fundamental analysis. On Wednesday, more of this will be covered. So maybe let's look at some of the questions that you guys have. Humphrey, are there times that the market doesn't react in the direction of the news? If yes, why? Yeah. There are times the market will not react to that, or at times, like I've said, the market will spike up and spike down. In trading, there's something you call liquidity areas where the market tends to go to positions where guys have set out their stop losses. And that's why maybe some of you will say, you'll hear people say that the market went to my stop loss, hit the stop loss and reversed, right? So that is a liquidity area. That means there are guys who had set out their stop losses at that particular point in time. Yeah, so at times when the market is priced in, like remember when you have, let's say, the interest rate as 5.5 consensus, and then all of a sudden 5.5 again comes out, then at that particular time you'll hear you'll see the market price in that, and it will be like no news came out, the continuation of the trend. This is where now the technical analysis plays out. Any other question? So guys, make sure that you're following our webinars. Make sure that you visit the FX Pesa YouTube channel, have a look at everything that is happening, the Snap Watch. Make sure that you're looking as a trader, you are up to date with whatever is happening, the market snapshot, and of course, the market pulse. Make sure that you're going through some of this data and get to learn from our team. Otherwise, thank you for everyone who has attended this session. See you on Wednesday. Karibu sana, Humphrey. I was just